And I think that's certainly something that we use a lot when building portfolios, is saying, a patient approach to investing at least takes away what I call the entry risk, the risk of portfolios falling quickly as they're built. So the selection of assets is interesting. As at the 31st of January, roughly 10% of the portfolio was in Australian equities and about 15% in international equities. So I think it's interesting. We have a big home bias in Australia, what I would call a home bias in Australia, and yet they've chosen to use more international equities at this point than Australian equities. The other thing is, then, of the other asset classes they've got investment, it's listed global property. And I think that's an interesting practical application of the fact that listed global property comes up as one of the least correlated asset classes with Australian shares, if we say that's where we traditionally build a portfolio, and therefore has actually worked out quite well for them. So a couple of other practical then observations. I think one of them, in terms of correlation, one of the interesting things to reflect on at the moment is the difference in business or investment cycles between Australia and the rest of the world. We're at a point in time where interest rates are very high, and there's a bit of a struggle to slow the economy. The rest of the world, US interest rates 2%, exactly the opposite. They're trying to stimulate the economy. A lot of talk in global markets about a recession, significantly less here, although I have noticed it's a little bit on the horizon. The difference in interest rates and economics growth, and certainly the difference in market returns. And for us to now, the genius decision has been just invest in Australian markets and forget about global markets. But it's almost like a different cycle, and the point of diversification could be significant there. I think the most practical thing to do is to come down and look at, in the current climate, how would we build a portfolio? And going back to that idea of what if markets were to fall by 30%, how do we use these sort of things to protect against that? And this is not dissimilar from what we went through on Sunday too, so I apologise to people who've kind of seen it again, but it's a different context here. Let's assume, for the sake of simple maths, that we're talking about $1 million portfolio. So what are some of the things we'd do? And let's assume that these people, whoever's portfolio it is, want to draw $50,000 a year. The great thing is, if we assume they're in retirement and they've got the money in a super fund, we can kind of assume away tax, because the earnings of the super fund are tax-free. The drawings from the super fund are also tax-free. So it's a nice, simple way to do it. So the things I'd be looking at, first of all, is to say, okay, what we need to do is we need to have a lot of money in those asset classes that are reliable, low volatility of returns, don't have particularly high correlation with anything else. And that clearly is cash and fixed interest. And where we would start with that is say, okay, let's put 5 years worth of income in cash and fixed interest. Even my maths can cope with that. And so that's $250,000. The rest then can be exposed to the higher return but volatile asset classes without people having to stay awake at night wondering, in 12 months' time, are they going to have enough money for whatever lifestyle needs they would want. Of the 750, I'd still be inclined to have more in Australian shares than anything else. And that's because of the tax benefits of franking credits. And an interesting point in looking at the fact the Future Fund has more money in global shares than Australian shares is, I wonder if they get a tax benefit from franking credits. I don't know what their tax status as an entity is and whether there's any advantage to them for that at all. And maybe that makes them less inclined and more inclined to say, well, returns are very similar, we'll go offshore. So this would and how you do that is obviously not quite this conversation, but it will flow interestingly onto the next seminar talking about high income stocks, because we then look at the income flow from these investments. You might then also have $200,000 in global shares. And 150,000 in property. Within global shares, you might say, okay, looking at diversification effects, we want a little bit in emerging markets. And that's been a significantly better performer over the last 8 years than traditional international markets have been. Emerging markets have been quite strong. There was a feature in the Australian Wealth section last Wednesday that looked at those performances, and they're about 17% a year over 5 years, which is quite a nice bit of extra return. Within property, maybe $100,000 in Australian listed property and $50,000 in